The escalating conflict involving Iran is sending shockwaves through global markets, but it's impacting the Forex and crypto worlds in almost completely opposite ways. To put it simply, while the Forex market is engaging in a classic flight to safety with the US dollar surging, the crypto market is revealing a fascinating tale of two cities, behaving like a risky asset on the global stage while simultaneously serving as a critical financial lifeline within Iran itself. Let's start with the impact on Forex trading, where the reaction has been swift and sharp, driven by two main forces: a desperate search for safety and a dramatic surge in oil prices. The primary beneficiary here is the US dollar, which is experiencing what analysts call the smiling dollar phenomenon. It's strengthening not only because it's the world's premier safe haven currency during geopolitical crises, but also because the US, as a net energy exporter, is relatively insulated from the oil price shock. This has challenged the traditional bearish view on the dollar, with Barclays estimating that the greenback could strengthen by up to 1% for every 10% increase in oil prices. Meanwhile, other traditional havens like the Swiss franc are also in high demand, particularly as a refuge for European capital fleeing the volatile Eurozone, with the Swiss National Bank signaling a willingness to intervene to manage the franc's strength. Gold is rallying alongside these currencies, reflecting a broader distrust of fiat money during wartime. The conflict has also created a clear divergence in the currency markets based on energy dependence. On one hand, you have the winners, the so-called petrocurrencies like the Canadian dollar and Norwegian krone, which are strengthening as major stable energy exporters, benefiting directly from soaring oil and gas prices. On the other hand, the losers are the major energy importers like the euro and Japanese yen, both under significant pressure because the surge in oil prices acts as a regressive tax on their economies. A sustained rise in oil prices could raise Eurozone consumer prices by almost 0.5%. This stress is even more pronounced in emerging markets, where currencies like the Indian rupee recently hit a record low, prompting central bank intervention, while the Indonesian rupiah and Turkish lira face similar downward pressure. Now shifting to the impact on crypto, the story gets much more complex, revealing the asset's dual nature as both a speculative global instrument and a practical tool in a sanctioned economy. On international exchanges, cryptocurrencies are decidedly not acting as a safe haven. Instead, they are behaving like high-beta risk assets, correlating closely with the sell-off in global equities. Following the escalation, Bitcoin fell below key support levels, trading near $66,000, while Ethereum and other major altcoins softened. This risk-off sentiment is reflected in institutional products too, with spot Bitcoin and Ethereum ETFs recording net outflows as investors reduce exposure. But inside Iran, the narrative couldn't be more different. Here, cryptocurrency is serving a critical function as a tool for capital flight and sanctions circumvention. Within minutes of the initial airstrikes, outflows from Nobitex, Iran's largest crypto exchange, surged by an astounding 700%, peaking at nearly $3 million per hour. From the first strike to just a few days later, an estimated $10 million in crypto assets flowed out of Iranian exchanges. This exodus is a direct response to the collapse of the Iranian rial, which hit a record low of 1.75 million to the US dollar after the strikes. With the Iranian banking system cut off from SWIFT, citizens and entities are turning to stablecoins like USDT to move value out of the country instantly, bypassing traditional banks entirely. Interestingly, this isn't just a grassroots movement. Research suggests that the Central Bank of Iran itself may hold at least $500 million in USDT on local platforms to use as a reserve asset, support the rial, and facilitate foreign trade while under sanctions. The stress on the system has been so great that several Iranian exchanges have even experienced downtime, possibly due to government-ordered internet restrictions or physical infrastructure damage. So just to recap the key contrasts, in Forex, the US dollar is seeing sharp appreciation driven by safe haven demand and net exporter status, while the Japanese yen and euro are weakening despite their safe haven status due to high energy import costs. Petrocurrencies like the Norwegian krone and Canadian dollar are appreciating on higher oil prices, whereas emerging market currencies face heavy depreciation from current account stress. In the crypto world globally, Bitcoin and Ethereum are declining alongside equities due to risk-asset correlation. But within Iran, stablecoins like USDT are seeing massive demand as tools for sanctions evasion and capital flight. I hope this detailed breakdown is helpful for your trading and business planning. The situation is highly volatile, and these trends could shift rapidly with any major geopolitical or policy change. Are there any specific currency pairs or crypto assets you would like to analyze further?